Hi, let's gain an understanding of an adjustable rate mortgage as a type of mortgage.
Adjustable rate. A fixed rate mortgage charges the same interest rate throughout the entire term of the mortgage. As a result, the buyer knows the exact cost of the loan and total interest paid, should payments be made exactly as the amortization schedule outlines. However, a buyer could also obtain an adjustable rate mortgage. Mechanics of an adjustable rate mortgage. This type of loan allows for the interest charge to fluctuate depending upon the terms outlined within the loan. An adjustable rate mortgage is also referred to as an ARM. How and when the rate may change is dictated by the terms of the loan. This can affect the amount of payment due. Components of an ARM include index, margin, also called spread, adjustment interval, interest rate caps, payment cap, and teaser rate. Index. Interest rate charged with an ARM may change based upon an index. There are several indexes that could be chosen to be used. The most common indexes are the one-year constant maturity Treasury security, the cost of funds index, and the London Interbank Offered Rate. These indexes are outside of the lender's control, reflecting the state of the economy rather than the whims of the lender to arbitrarily increase or decrease rates. Margin. The margin of an ARM is the amount the lender adds to the index as profit. The amount of margin added may vary based on a borrower's credit. Borrowers with stronger credit can negotiate a lower margin. Index plus margin equals full indexed rate. Adjustment interval. Interest rates will be adjusted based on the allowable time interval agreed upon with the terms of the loan. This is called the adjustment interval. The period between the change is called the adjustment period. Adjustment periods may be months, quarters, or years. A loan with an adjustment period of 1 year is called a 1-year ARM. A loan with an adjustment period of 5 years is called a 5-year ARM. Interest rate caps. Interest rate caps limit how much the rate may increase. There are two types of caps imposed upon an ARM. Periodic caps limit the amount that the rate can increase from one interval period to another. Lifetime caps limit the amount that the rate can increase in total over the life of the loan. Payment caps. While interest rate caps control how much the interest rate can change, the payment cap sets a limit as to how much the payment can be increased in between terms. The purpose is to protect the borrower from payments being increased to a point that the borrower cannot afford to make the payment. Negative amortization. Payment caps create a risk of negative amortization. A combination of increasing interest rates with payment caps that keep a payment from rising can produce a payment that does not cover the amount of interest being charged each month. Therefore, instead of the monthly payment paying down the unpaid balance, more debt is being added each month. When the debt is increasing each month, this is called negative amortization. Teaser rates. Another feature you sometimes see with an adjustable rate mortgage are teaser rates. Teaser rates are also called discounted rates or start rate. It is an initial rate that is lower than the fully indexed rate. The lender charges a higher rate after the initial discounted rate period passes. These types of loans are often combined with larger initial loan fees. The initial low rate and subsequently lower payment makes the loan appear to be more attractive. Adjustable rate mortgages. Remember that when it comes to practicing real estate, it is not your job to act as a mortgage loan originator. That means that you won't be advising your clients about what type of loan is best suited for them. However, great resources that you can direct your clients to are the Consumer Financial Protection Bureau website, as well as a consumer handbook published by the Federal Reserve Board. This helps them to be empowered to make well-informed decisions when comparing fixed rate mortgages to adjustable rate mortgages. The CFPB website found at consumerfinance.gov explains the components of a monthly payment and breaks down mortgage options. It also has a great how-to guide. The Federal Reserve Board Consumer Handbook can be found at consumerfinance.gov. This brochure is a 45-page document that does an excellent job explaining the various aspects of adjustable rate mortgages. So although you should be careful not to act as a mortgage professional by giving loan advice, it is to your client's advantage to be directed to information they need to help them make a decision, and your client will thank you for it.